Let's talk about one of the biggest debates in investing. You've got two rival camps, each with a completely different way of figuring out where the stock market is going to go. It's kind of like a showdown between a detective and a psychologist, and today we're going to crack the code. So let's get right to the heart of it. What really makes a stock's price move? Is it the cold, hard numbers, the actual value of the business? Or is it something a little messier, like the totally unpredictable emotions of the crowd? Is this all about logic, or is it really all about feelings? To figure that out, let's meet our two main players. On one side, you have fundamental analysis. These guys are all about the why. Why is this company a good investment? And on the other side, you've got technical analysis, which is totally focused on the when. When is the exact right time to make your move? All right, first up, let's meet our financial detective. This is your fundamental analyst. They believe that underneath all the daily noise and the chaos of the market, every single company has a true core value. And their whole job is to put on the trench coat, get out the magnifying glass, and figure out exactly what that value is. So their whole mission is to find something called intrinsic value. What is that exactly? Well, think of it like the real, true price tag of a company, based on how healthy it is and how much money it can make. The whole point is to compare that real value to its stock price today and ask, is this a total bargain or is it ridiculously overpriced? So what kind of clues are our detectives looking for? They dig deep into the evidence. They're poring over financial statements, checking out the company's leadership team, sizing up the entire industry, and even zooming way out to look at the whole economy. Stuff like GDP and interest rates. And this quote from Benjamin Graham, who's basically the godfather of this whole approach, just nails the philosophy perfectly. What he's saying is, day to day, the market's just a popularity contest. It's a voting machine. But in the long run, what really matters is the company's actual substance, its financial weight. The detective's job, ignore the daily voting and focus on the long-term weighing. But what if the most important clues aren't buried in some financial report? What if they're actually hiding in plain sight, just in the patterns of the market itself? Well, that brings us to our second character, the crowd psychologist, or the technical analyst. They're not so interested in the company's books. They're fascinated by the market's mind. Now, this approach is built on a pretty radical idea, that everything you could possibly need to know, all the fundamental data, all the news, all the hopes and fears, it's already reflected in a stock's price chart. They believe that chart, showing price and volume, tells you the complete story of supply and demand, period. So what's in their toolkit? It's all about watching the crowd's behavior. They're looking at charts for trends. They're studying trading volume to gauge the conviction behind a move, and they're searching for specific patterns that might signal a shift in the market's mood, because they believe that human psychology in markets repeats itself over and over again. And these three ideas right here are the absolute bedrock of their belief system. First, market action discounts everything. That just means the price already knows all the news. Second, prices move in trends. They believe price movements aren't random. And the big one, history repeats itself. Because the things that drive the market, human emotions like fear and greed, they never really change. For decades, these two approaches were bitter rivals, and the entire academic and financial world pretty much sided with the detective's fundamental approach. But then, some absolutely stunning evidence came out from a place you'd never expect, and it completely flipped the script. You have to understand, for the longest time, serious financial research basically treated technical analysis like it was financial astrology or something. The real work, they said, was in the economic data. But then a study from, of all places, the U.S. Federal Reserve decided to actually put that idea to the test. And the results? Whoa. They were a total bombshell. The Fed researchers tested 14 of the most common technical indicators to see if they could actually predict future stock returns. And what they find? An incredible 13 out of those 14 showed significant predictive power. They worked just as well and sometimes even better than the classic economic variables. So this was a massive shock to the system and a huge win for the technical crowd. But it raised an even bigger, more interesting question. Why? Why on earth did it work so well? What's the secret signal that's hiding in those charts? Seriously, think about it. What are these price trends and volume spikes really telling us? If it's not just random static, what's the message that it's sending? And here it is. This is the big breakthrough. The Fed study figured out that technical analysis works because it's an incredible stand-in for something called investor sentiment. And that's just the collective mood of the market, that overall feeling of optimism or pessimism that's driving all the buying and selling, often completely separate from a company's actual performance. And check this out. When you see the results head-to-head, the numbers are just crystal clear. When the researchers tested what could predict these big swings in market mood, the results were stunning. As you can see, 12 out of 14 technical indicators could do it. The fundamental economic data showed no significant ability to predict sentiment shifts. Zero. So the huge takeaway here isn't about one side winning and the other side losing. This is no longer the detective versus the psychologist. The real game changer is realizing how unbelievably powerful they can be when they actually team up. See, the smartest approach isn't about picking a side in this old debate. It's about using their strengths together. Fundamental analysis, the detective work, is amazing for figuring out what to buy. It helps you find those really solid companies. And technical analysis, the psychologist's work, is the key to deciding when to buy by helping you read the market's mood. So, how does this actually work in the real world? Well, imagine this. Step 1, you put on your detective hat. You use fundamental analysis to find a great company. Let's call it Future Corp. It's got great earnings, low debt, it's a solid what. So, you put it on your watch list. Then, step 2, you become the psychologist. You look at Future Corp's chart and see the stock's been trending down, but now the selling seems to be slowing down. You use technical analysis to wait for a clear signal that the bad mood is over and positive momentum is starting to build. That's your when. You combine the what and the when for a way smarter decision. And listen, this isn't just a nice theory. It is backed up by the research. The very same Federal Reserve study concluded that when you combine both methods, you get superior forecasts and substantial utility gains as an investor. It really is literally the best of both worlds. So we'll end on this thought. We've seen that the market is this complex beast, and it's driven by two massive forces: the logical, real value of a business, and the emotional, often illogical, mood of the crowd. Our detective and our psychologist each hold a critical piece of that puzzle. So the only question left for you is, which half of that story might you be missing?